Hey there, future retirees and tax-savvy investors. Welcome back to XTRM Finance, where we take the confusing world of taxes and turn it into something that actually makes sense. Today's video is one that's going to make you feel like you're cracking a secret code, because we're talking about how to legally pay 0% capital gains tax on $100,000 in retirement income. Yes, you heard that right, 0%. Now, before you start thinking, is that even possible? I can assure you it's absolutely doable, but of course there are a few rules you need to know and a little strategy involved. So if you're ready to say goodbye to the IRS taking a chunk of your retirement money, stick around because we're about to break this down step by step. But first, if you love keeping more of your hard-earned money, make sure to hit that like button, subscribe, and share this video with someone who needs to stop overpaying on their taxes. Trust me, they'll thank you later. All right, let's dive in. Before we get into the juicy stuff, let's quickly refresh on what capital gains tax actually is. Simply put, capital gains tax is the tax you pay when you sell an asset like stocks, real estate, or even collectibles for a profit. The amount you pay depends on how long you've held the asset and how much profit you made. There are two types of capital gains tax: short-term capital gains, which are taxed as ordinary income, and long-term capital gains, which are taxed at a lower rate. If you sell an asset within a year of buying it, the IRS treats it like regular income and taxes you at your regular tax rate. However, if you hold an asset for over a year before selling it, you pay a much lower tax rate. In fact, long-term capital gains tax rates are typically 0%, 15%, or 20%, depending on your income. Now, most people think they'll automatically pay that 15 or 20% rate, but today I'm going to show you a way to legally pay zero on $100,000 worth of capital gains in retirement. All right, let's get to the good stuff. How exactly can you pay 0% capital gains tax? Here's the secret sauce: your taxable income. Yes, the amount of money you make during retirement plays a huge role in determining your tax rate. For most retirees, capital gains can be taxed at 0% if your taxable income falls below a certain threshold. But here's the kicker: we're not talking about how much money you make before taxes. We're talking about your taxable income, which is your income after deductions, exemptions, and other tax breaks. So, how do we get to zero? There's a magic number you need to know. In 2024, single filers can earn up to $44,625 in taxable income before paying any capital gains tax. And if you're married and filing jointly, that number jumps to $89,250. Now that's a game changer, right? But wait, it gets even better. When you hit those numbers, your long-term capital gains, meaning the money you make from selling assets you've held for more than a year, won't be taxed at all. So how do you make sure you stay below those thresholds in retirement? Let's break that down. Here's where the magic happens. How do we strategically generate $100,000 in retirement income without paying a single dime in taxes on it? The trick is a combination of tax-deferred accounts, tax-free accounts, and income splitting. Let me explain. Utilize tax-deferred accounts. Traditional IRA 401k. Your traditional IRA or 401k is a fantastic place to build wealth, as contributions are tax-deferred. You don't pay taxes on the money you contribute today, but when you withdraw from these accounts in retirement, you will pay taxes. But if you control the amount you withdraw, you can keep your taxable income low. Here's the strategy. In retirement, you only need to withdraw enough from your traditional IRA 401k to keep your taxable income below those thresholds. For singles, $44,625, and for couples, $89,250. If you withdraw just enough to stay under that amount, you won't owe any tax on your capital gains. That's how you could potentially pull out $100,000 in total retirement income without paying any tax on it. Make use of tax-free accounts like Roth IRAs. This one's key: Roth IRAs are tax-free. The money you withdraw from a Roth IRA, whether it's qualified distributions or capital gains, is not taxed. So, if you have a Roth IRA and you've met the required age and holding period, you can withdraw up to $100,000 and pay zero taxes. This is a great way to supplement your income in retirement while staying in that 0% capital gains tax bracket. Income splitting with your spouse can be a smart move if you're married. Here's a little trick. If you file jointly, the tax-free capital gains threshold doubles. That means you can work together with your spouse to withdraw up to $89,250 each, resulting in $178,500 in retirement income without paying capital gains tax. So by splitting your income strategically, you can stay below the thresholds and keep your taxes zero. Pretty cool, huh? So now you know how to keep your taxable income low and legally avoid capital gains taxes. All right, let's go even deeper into how you can maximize those tax-free opportunities and make sure you don't accidentally cross those income thresholds. Harvesting capital losses is a useful strategy. If you've sold some assets and you've made a profit, you can use a strategy called tax loss harvesting. Let's say you sell a stock that's down and offset your gains with that loss. This lowers your taxable income and helps you stay under those thresholds. Social Security optimization. Did you know that your Social Security benefits might not be fully taxable? In fact, depending on your income, up to 85% of your Social Security benefits could be tax-free. This is another source of income that can help you stay under the $44,625 or $89,250 thresholds. Just make sure you're withdrawing from taxable accounts in a smart way, so you don't accidentally trigger higher taxes. Health savings accounts, HSAs for retirees. If you have an HSA, you can use that money to pay for qualified medical expenses in retirement completely tax-free. Plus, if you're over 65, you can use HSA funds for anything, not just medical expenses, without penalties, though you'll have to pay regular income tax on the withdrawals. Roth conversions. Another strategy is doing Roth IRA conversions during low-income years, especially in the early years of retirement, to fill up the lower tax brackets. This allows your money to grow in a Roth IRA, and you can pull it out tax-free later on. Just make sure to time it right so you don't push yourself into a higher tax bracket. Now, as you start to plan out your strategy to pay 0% capital gains tax, here are some common mistakes you'll want to avoid. Number 1. Not tracking your total income. It's easy to focus only on your capital gains, but don't forget that Social Security, pensions, and other income count towards your total taxable income. Make sure you have a plan for keeping everything in check. Number 2, selling too early. If you're in the early stages of retirement, it's important to pace yourself with how much you sell each year. If you take a huge distribution from your taxable accounts, you might push yourself into a higher tax bracket. Number 3, not considering state taxes. Keep in mind that some states tax capital gains differently. States like California, for example, tax capital gains as regular income, so plan accordingly. So there you have it, strategies to pay 0% capital gains tax on $100,000 in retirement. It might seem like a lot to digest, but once you break it down and start planning, it's totally doable. If you found this video helpful, don't forget to smash that like button, subscribe, and share it with someone who needs to know about these tax hacks. Got questions, or maybe you've got a strategy that's worked for you? Drop a comment below. I'd love to hear from you. Remember, taxes don't have to be scary. With the right planning, you can enjoy a tax-free retirement. Thanks for watching XTRM Finance, and I'll see you next time with more strategies to help you take control of your financial future. Peace out.